Hi, my name is Peter Resnicek from ShadowTrader.net, and if you're a day trader, what I'm about to show you is going to change your trading life. Let's start here with this chart. This is a pie chart of the 11 sectors that make up the S&P 500. And I'm showing you this chart specifically on today. I'm recording this video on May 31st, 2022 for two specific reasons. One, every end of the month, on the last day of the month, is the day that the S&P rebalances the 11 sectors and gives them a new weight. So if you can see here, starting from the top, information technology is the heaviest weighted sector, followed by healthcare, financials, consumer discretionary, communications, etc. And they each have a certain weight in the S&P. So for instance, when stocks that are in the information technology sector, such as Google, etc., when they go up, it has that much more effect on how much the S&P actually rises. But when stocks that are in the real estate sector, for instance, go up, it actually has very little effect on the S&P because en masse altogether, real estate stocks make up less than 3% of the S&P. So again, at the end of every month is when this is rebalanced. The other reason why I'm talking to you specifically today is because today, on May 31st, 2022, there are some amazing examples that I'm about to show you of an indicator that I've come up with called the weighted advanced decline line that can actually show you exactly when the turns in the market are happening during the day. And if you're day trading or you're swing trading, regardless, this is going to be of immense value to you. So let's get into it. Now, before we get into the specifics of how this Tuesday, May 31st, 2022 played out, let's pull back a little bit to a larger time frame so we can get a look at the context surrounding this day as terms of how the market was reacting coming into it. So we can see very clearly here on the chart, we had sort of a double bottom action here in the market where there was a false breakdown. And before this day occurred, there was a sharp rally last week. Yesterday, which was Monday, was a holiday. The market was closed. But last week, Wednesday, Thursday, Friday, was a sharp rally that really just went in one straight line with three green candles. Coming into the market today on Tuesday, May 31st, the thinking would be naturally that there should be some pullback, at least some percentage of this move should come in, especially given the fact that the market is still relatively bearish and longer term trend lines in the market really haven't yet been broken. So that's really kind of the thinking coming into the market. And that sort of thinking, of course, before the market even opens or shows you its hand and what it's doing can get a lot of traders into trouble. And that's why what I'm about to show you today, I think should be very interesting to you because the indicator that I'm about to show you is going to absolutely positively keep you out of trouble, and it is going to tell you exactly what the market is doing at every particular turn because it is based 100% on the 11 sectors of the S&P that I just showed you in a weighted manner. Because remember, from the beginning of the video, it matters a lot more, for instance, if stocks that are in information technology or healthcare or consumer discretionary are moving up than it does if energy or real estate or materials are moving up. The sectors that have heavy weight in the S&P are the ones that actually move the S&P, and the ones that have lower weight actually don't really do it all that much. Now let's come off that daily chart and move one step lower to a 15-minute chart so we can get an idea of exactly what was going on in this particular day and why it really was a tricky day. And if you don't have the right tools to apply to the day, you can get in trouble and lose a lot of money. This area here is right where the day starts. And remember what we talked about earlier, saying that the market has been up big for 3 trading days in a row. So you would expect that at least early in the session there would be some give back, some sort of corrective activity, as we call it, to the inventory position, which has gotten itself overly net long in the markets. And we can see here on this first candle from 9:30 to 9:45 a.m., the market does exactly that. It actually does come down pretty strong. This is the S&P on a 15-minute chart. Market comes down pretty strong, and most traders would expect that, especially given the context of how much the market has been up, there should be some follow-through at that moment, right, after that first 15-minute bar. But we can see here that the second 15-minute bar actually does nothing, and right here there is a fake out. The third 15-minute bar actually just goes down, makes a new low by very, very little, and then starts to rally. After that, notice that the market rallies, and we can draw another uptrend right here, and here sellers are emboldened again. You can see in this little red candle here, market comes down hard, breaks trend. What happens when you break trend? The simple rule of thumb is if you break trend, you target the prior low where you just came from. Should be, right? So probably lots of traders seeing this, getting short on the trend line break, pressing the bet, thinking that the market needs to correct, and they're probably shorting some more. But what happens there? Again, complete lack of follow through, where as you can see, you have just one 15-minute bar to the downside. You go sideways for the next 15 minutes, and then boom, you take off big to the upside. If you were just trying to day trade just off of the chart patterns that I'm showing you here, and you didn't have any market internal context to go by, you would definitely lose, because as you can see, these patterns fail miserably all the time. This is very, very common in trading. If you're simply a pattern-based trader and you're not using market internals or certain tools that can help you to know the strength and weakness of the moves that are behind the candlesticks, you will not be successful in the day trading game. And certainly on a day like today, you can see that we had two back-to-back pattern failures where, again, the first 15-minute bar was big bearish to the downside, closed near the lows. That would imply more, especially given the context. It goes nowhere, the market rallies, and then again, when it rallies, comes up, breaks trend to the downside, but again, zero follow through, and the market rips back up to the upside. Moving down one more time frame, this chart is a 5-minute, and I've drawn in using vertical lines the exact two places that we just talked about in the 15-minute chart where the big fake out occurred. So when I get to the next chart, when I show you how the actual indicator acted at these exact times, I want you to remember these exact two times, which are right here, which are 10:10 a.m. and 11:35 a.m. Okay, again, that's 10:10 and 11:35, and you can see it here on the chart. This is where we make that first big low in the first 15 minutes. Here's where we have that little fake out low, and this is the exact bar when it goes very awry for everybody who was still holding short. Same thing here at 11:35. If you recall, we had that trend line break. We broke trend. If you recall, I said we went sideways for 15 minutes, and right here, boom, at 11:35 on that bar is when it went awry, if you will, for the shorts. So now that we've looked at the charts and we've seen where the turns occurred, remember it was 10:10 a.m. and 11:35 a.m., let me show you this indicator, which I truly believe is going to change your trading life, because this indicator is going to show you where those turns occur on trending days. It's going to confirm those trending days. Whenever the market makes any type of move in any direction, this indicator is either going to confirm or deny that move, so that you know which side of the market to be on when you are trading in the day time frame. So first, a little primer on what this is and how exactly it works. We call it the weighted AD indicator. It's available for thinkorswim and also for TradingView. There'll be some links at the end of the video and in the description that'll show you how you can get it. Basically, what it does is this. It takes the 11 sectors of the S&P and it plots them in two different manners, in a weighted manner, which is the histogram, the purple and yellow, and also in an unweighted manner, which means if we took all of the 11 sectors from information technology all the way down to energy, and we gave them all an equal weight and we plotted them, how would it look? And that is the white line that you see here. Both calculations start each day fresh from the open, and they are cumulative. So whatever the percentage gain or loss is of every one of those 11 sectors, this indicator is calculating it on the fly. We have a little bit of math thrown in that basically turns it into a number, and it's giving us a cumulative number that is starting right from the open, and we are then simply charting that figure from the open, both in a weighted manner. We have the weighted number and we have the unweighted number. So obviously, if the histogram and the unweighted line are moving together, it tells you basically that all of the sectors are pulling in the same direction. Now, obviously, there will very often be all sorts of divergence, which also can be very valuable to know. And we'll get to that in a second. Sometimes the unweighted line is way above the weighted line. Sometimes the weighted line is way below. astute traders that are listening to this for the first time, you should already have major light bulbs going off in your mind, understanding that, aha, this is huge information that can really help me to know how strong or how weak a move in the S&P and hence the ES futures is at any given time, because obviously if the unweighted line, which is the equal weighted line, is leading, let's say, way above the weighted line, that's often unsustainable, right? We know that in order for the S&P to continue in one direction, you need the heavyweight sectors such as information technology, consumer discretionary, healthcare, etc., to be rallying. And also, if we want the market to be going down, and we expect that move down to be sustainable, you need those same sectors that I just mentioned to be weak. So you would need that histogram way below the zero line and really, really pushing much lower, okay? So let's take a look at how this indicator acted at the key times that we were talking about, which is 10:10 a.m. and 11:35. And remember, in both of these instances, the market was telegraphing chart-wise that it should go lower, but it faked everybody out and the market actually didn't go lower, right? We know that in both of those instances, the market ripped to the upside. So what was our indicator doing? So notice here, this activity here is from the open, okay? Right here is the beginning of Tuesday, and it makes perfect sense because the market was going down. This is on a 5-minute, by the way. Remember, we talked about that first initial candle being 15 minutes straight to the downside, so obviously that was the first 3 5-minute bars put together. But obviously you can see that the market is going down, but what happens right here, and you can see I drew the lines exactly dead on where the change occurred. Notice that both the histogram, which was showing you what the weighted sectors were doing from the open, and this is very, very important. All of this is a cumulative number from the open because that's the information that is most important in day trading. Very important to note, and this is a little bit of a sidebar, but remember this, if you are day trading, you really should only be concerned with what is happening from the open, not the gap, not the distance from the prior day's close or whatever, not measuring performance from the prior day's close. Look at everything in terms of what it's doing from the open, and that will tell you its relative strength or weakness, and then you'll be able to trade that instrument accordingly. So again, from the open, on a cumulative basis, notice what happens. Bearish, 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 but right at that 10:10 mark, as I was saying, notice that the histogram is actually a very tiny bar. You have these huge yellow bars to the downside, and the unweighted line rather, which is the white one, is also very, very low, indicating the bearishness in the first 15 minutes. But look at how quickly that shifts. If the market was going to continue lower, then it would make absolutely no sense for something that is measuring the percentage advance or decline of all of the 11 sectors that make up the S&P. Why would it improve so greatly immediately? And notice what happens right away on the next bar, positive, positive, positive. It all just shifts right there, okay? Let's look at the second example, which was the 11:35 example, right? We know that the market rallied, which is this, and you can see the weighted, unweighted confirming that rally, right? And not only confirming it, but notice that the histogram, if you look closely, is above the weighted, the unweighted, the equal weight. The histogram, which is the weighted, is above the unweighted. And for a move to be sustainable to the upside, that's what you want to see because, again, as I was saying, it tells us that infotech, healthcare, consumer discretionary, etc. are leading the charge, and that will have some staying power. So we get that bit of a rally, and then as we know, we get that trend line break that I showed you on the prior chart, and that brings the histogram all the way down to here. And look what happens. As it falls down, remember in the prior charts, I said that we broke trend and the idea was that we should keep going to the prior low, right? We call that filling up the triangle where, for instance, you have the hypotenuse, you break the hypotenuse, where should you go? To the base. But we got a fake out. When we started to come down halfway and we paused, if you recall, there was 15 minutes where the market went sideways. In those 15 minutes that the market was going sideways, look at what the indicator was doing. Small histograms that were positive. The indicator never went negative. Never ever went negative. If the market was, after breaking trend, was going to continue, this should have went negative, especially with such a precipitous decline of the indicator from here to here. And yet, never went negative, printed the exact same bars, And then what happened? And again, boom, shoot to the upside, right? So again, you get that fake out, but this is telling you that what's happening under the hood, that the 11 sectors of the S&P are not all that bearish. Let me show you one other thing which is absolutely fascinating about this. When the market broke trend on the 1135, move down, right? Or before the 1135. 1135 is basically where the shorts got stuffed, right? And this is where we had the big turn right here. But before that, when we broke trend and came down to that midpoint before we made the 15 minutes sideways, look at this divergence, which is amazing. Look what happened as the market came down. Only the equal weighted line went negative. So what's happening there? Energy, materials, real estate, etc. Those sectors that have very little bearing on how the S&P is actually going to move, they all went pretty negative. They fell apart pretty hard, which is evidenced by the indicator that shows us that they actually broke the zero line, and look at this activity, they all went negative. But while that was happening, the divergence tells you that the move is not sustainable to the downside, because if it was, the weighted sectors as measured by the histogram would also have gone negative, and they didn't. They stayed positive, and then again, off to the races again, and boom, the market takes off to the upside, and you can see everything confirms with the indicator where the histogram is way above the equal weight line, and the rest is history. And I'm so glad that this happened today, and I'm able to show this to you using this type of day, because it's exactly the type of day where this indicator really shines. It's showing you those areas where, once again, the charts are telling you one thing. If you're just using straight technical analysis, the charts, to me, we're saying lower after the first 15 minutes, and certainly lower here after that trend line break closer to midday, right, as you approach that 1135. But under the hood, the market was actually telegraphing something completely different. The weight, if you will, or the oomph and the momentum to the downside, it wasn't there. Early on here, it just changed very quickly. It had it, and then there was a quick change. This happens, and again, if you're just looking at charts, you wouldn't know it. And here, when the market actually pulled in a little bit, it really didn't have those stronger sellers behind it, as we can see, because that weighted histogram never went negative. This amazing indicator is available at our website, shadowtrader.net. You can see it right here. All you have to do when you're there is mouse over the Stocks tab and choose Weighted AD Line ThinkScript, which will bring up this page. It is $95. An amazing deal, really, really inexpensive. And again, I do believe if you just put this on your charts, start watching it, you'll get very acclimated with it in a short period of time. It will change the way that you look at markets. If you use TradingView, we also have this indicator available as well. Check this link down below. It's www.technimentals.net. Again, that's technimentals.net, and the indicator is available for TradingView there at the same price. I highly recommend, if you are an active day trader, especially of futures, ES, this really is going to have a huge impact on your trading. You're going to be timing your moves better. You're going to be seeing more things, and you're certainly going to be making a lot more profits because you're going to be consistently on the right side of the market.